continuing with chapter two, cash flow of the firm, as the book calls it. I was taught cash flow to the firm, so probably will refer to that as that at some point. It means the same thing, but one of the most important things is we can extract from financial statements is the actual cash flows of the firm. Yeah, there's no magic to finance. The has to be that the cash flow received from the firm's assets have to equal cash flow from the firm's creditors and stockholders. We have a accounting relationship for that. The cash flow from assets. There we go. So this is cash flow from assets has to equal the cash flow to bondholders plus the cash flow to equity or stockholders. Note that this is the balance sheet equation. Total assets equals total liabilities plus total equity. This is the same relationship that we're talking about here. So, cash flow of the firm is we take here we have operating cash flow, which is EBIT plus depreciation minus the current portion of taxes. We wouldn't be concerned with the accrued any accruals. We're just talking about we want to take anything that's not an accrual out of the calculation, so we get actual cash flows. Then we move on to capital spending. Capital spending is net capital spending, so it's a purchase of fixed assets minus the sale of fixed assets. And then finally, net working capital is simply net working capital is current assets minus current liabilities. We calculated it before. Net working capital grew from 252 million to 271 million. That's an increase of 19 million. So the cash flow to the firm ends up as $42 million. So again, the cash flow of the firm has to equal cash flow to investors in the firm. So the first portion of that is the debt portion. So we have the cash flow to creditors is we take interest and we add retirement of debt. So that's everything that flowed out to the creditors. And then we the next is the proceeds from long-term debt sales. So we subtract that out. So the total is what we paid, the 122 minus the proceeds of 86 million, so a net of 36 million. We do the same thing with equity. So cash flow to stockholders. We add dividends to any stock repurchases, so that's cash flow to stockholders. Cash flow from stockholders would be as a proceeds of any new equity sales. So in here we had 43 million, so the net is 6. So again, the 42 million of cash flow of the firm has to equal the cash flow to the investors. So that's our accounting relationship. The balance sheet equation, assets have to equal liabilities plus equity. There's an accounting statement of cash flows. That helps us explain the change in accounting cash and for our fictitious corporation for the year. There are 3 components of the statement of cash flows. The cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So when we calculate the cash flows from operating activities, we take net income, we add back depreciation and any deferred taxes. Deferred taxes and accrual, just like depreciation. We will eventually pay the deferred taxes, and then we make adjustments based on changes in assets, liability. So accounts receivable was the it was 24 million change. Inventory increased by 11 million. The accounts payable increased by 35 million, and so the change from operating activities is 207 million. Then we move on to the cash flow from investing activities. So it's just the same as we did before when we were calculating the cash flows of the firm. Acquisition of fixed assets, so that's an outflow. The sales of fixed assets is an inflow, so the net is 173 million. And then we do the cash flow to and from creditors. So we had 73 million of retirement of long-term debt. We received 86 million from debt sales. We paid out in 43 million in dividends. We repurchased 6 million in stocks, and then we received 43 million from the proceeds from the sale of stock. So the net cash flow from financing activities is 7 million. So we combine all these into one statement, and we add our 207 million to our cash flows and from investing activities, which is an outflow, and then add the cash flow from financing activities, and we end up the change in cash flow on the balance sheet of $41 million. Next is earnings management. Earnings can be manipulated. We can think of some, pretty good examples of that. The probably biggest examples were Enron, WorldCom. If you're not familiar with those, you might want to look those up. Other companies manage their earnings on a regular basis by doing accounting manipulations and so forth. I mentioned previously that I worked for PNC Corporation. PNC actually used to, when I was working there, they would lay off people at Christmas and take a charge at the end of the year, and then rehire them after the first of the year. So, and then they could write off that charge, and it would bump their first quarter income for the next year. So, kind of a sleazy practice, but they did it on an annual basis. Luckily, it never happened to me, but it did happen to friends of mine. They got laid off in December, hired back in January or February, and so kind of a crappy way to do business, but it does happen. So the total cash flow is more objective, but underlying components can be managed based on the accounting decisions you make. The big one is the inventory, whether you choose LIFO or FIFO. You can move cash flow from the investing section to the operating section. Makes the business appear to be more stable. So to finish up the chapter, we've got the quick quiz. The first question is the difference between book value and market value. Book value is an accounting value. It's based on what you actually paid for the item, whether that be whatever that minus the depreciation. You would use market value for decision-making purposes. Similarly, accounting versus income versus cash flow. We recall the matching principle of accounting requires us to recognize expenditures and receipts when when we enter into a transaction, so we end up with accruals. So accounting cash flow is not the same as true cash flow. We should use true cash flows when we make our decisions. So that's something that would be important to remember throughout the semester, because all of our analysis will involve the use of true cash flows, and we'll be doing a lot of calculations where we actually have to calculate true cash flows. So, difference between average and marginal tax rates. This is less important to understand now because we currently have a flat corporate tax rate of 21%. If you saw in the example, there used to have many different corporate tax rates. But anyway, average is your total tax liability divided by your taxable income. Marginal tax rate, you can say it, is a tax rate which was applied to your last dollar of income or your next dollar of income. But when making decisions, you want to use marginal tax rates. And then finally, how do we determine a firm's cash flows? So the first thing that we want to do is calculate operating cash flows. That's our EBIT plus depreciation minus the current portion of taxes. Then we calculate net capital spending, so acquisitions of fixed assets minus the sales. And then finally, we calculate the change in net working capital. Remember that net working capital is current assets minus current liabilities. The change in net working capital is just the ending net working capital minus the beginning. So that is the end of chapter 2.